Welcome to Stocks in Translation. I am your host, Jared Blickery, joined by the voice of the people, Sydney Freed. And before we get started here, be sure to like, subscribe, and comment on Stocks in Translation on your favorite podcast network. And today we are proud to welcome Greg Dacko. Greg, you are the EY chief economist, and we've got a lot of stuff to break down today in the U.S. and global economies. And we're going to try to make sense of some of the mixed messages out there for investors. Our phrase of the day is supply-side dynamics, so echoes of the Gipper, anyone? It's a little bit different. And this episode is brought to you by the number 8.04 million. That is the number of job openings per the latest JOLTS data. We're going to take a look at the labor market, tea leaves, and divine the future of labor. And Greg, before we really get started here, just want to get your big picture overview of how you're seeing the U.S. economy.
I think generally speaking, the U.S. economy is still quite robust, surprisingly, though, because we're just coming out of a very significant round of tightening by the Fed. And many were expecting at the start of the year to see a recession. Last year, there was also talk of a recession, yet the economy still growing at about a 3% pace. I think one of the most important developments of late is the fact that income growth was revised higher, both in terms of gross domestic income, which is the equivalent of GDP, and personal income, what feeds into household spending power. Both were revised higher, and both show sustainable momentum when driving the economy forward.
It's really interesting because we're getting a read on the consumer right now with earnings season, and we'll be able to dig into some of those trends in a minute. First, I want to get to our phrase of the day. It is supply-side dynamics, and I kind of mentioned the Gipper before, which is a tongue-in-cheek reference to Ronald Reagan. But that was supply-side economics, something a little bit different. Supply-side dynamics is, and it refers to the real-world factors that are impacting production, such as labor availability, technology, and regulations. These dynamics shape how effectively that goods and services are produced to meet demand within an economy. So this is something that you study. What do you make of this?
Well, I think one of the very interesting developments of late is the fact that supply-side dynamics are a greater driver of economic activity.
Than the demand side.
Yes, for the last 40 years, demand-side drivers were really the key drivers of economic activity, and business leaders throughout the country and globally were really focused on demand-side economic drivers. But when you look at the economy today and you consider geopolitical developments, political developments, supply chain developments, labor developments, all of those point to a greater influence from supply-side factors. Industrial policy is another great example of supply-side factors influencing how business activity is evolving. I think that's very important to understand because it's likely to become the new normal. In this environment where you're seeing more influence from the supply side, it changes the dynamics when it comes to how businesses are thinking about economic activity.
So simplify it for me. More supply drivers to the economy now versus before it was demand. What are those two things? Supply, demand. How do you define those?
Well, I mean, it's the very basic of economics, right? Supply and demand. And we had a unique shock with the pandemic that really disrupted both the demand side of the economy, but also the supply side of the economy. And it's an unusual shock that we went through. Usually, you have these types of shocks when there is a war somewhere in the world or a global war. This was the equivalent of a world war because we had a sudden stop to demand and supply. Now, we saw that demand came back very fast because we had a lot of fiscal stimulus pumped into the U.S. economy, pumped into economies around the world. That supported income and, in turn, consumer spending activity. So that was the key catalyst to the very rapid rebound that we saw post-pandemic. But the supply side took longer. So we had supply chain disruptions. We had the lack of available labor. We had capital that was constrained. And all of those insufficiencies when it came to the supply side of the economy led to inflationary pressures. Demand very strong, supply catching up. That led to the inflationary pressures. Now, there is that growing focus on sustaining strong supply side dynamics on the labor side, on the capital side, and increasingly on the productivity side. That is the key to sustaining strong growth without inflationary pressures.
You know, some of the key things that you're getting across here is this is a new game for a lot of people. In my lifetime, I really haven't seen this. Maybe go back to when I was still watching the gas lines from my baby car seat in the, with my dad. But I was just wondering here, like, economists rely on models, but a lot of models have broken recently. What are you finding? Are you finding that you have to reinvent certain things? Are you going back in history, looking at older models? What's the process there?
Well, I think a model is good in the sense that it helps you frame a discussion, frame a problem, and resolve the problem in a quantitative way. But you have to be careful at how models are calibrated. There's that regular quip of, would you rather have Bob Solow, the Nobel laureate, as an advisor or a model? And the answer is really you want to have both. You want to have the expertise and the know-how, but you also want to have a quantitative framework. So to answer your question, the reality is that you really need to rethink some of the traditional relations between variables. And whereas in the past, demand side factors were the key drivers of economic activity, increasingly, you have to focus on the supply side factors. You have to consider what a government is thinking about in terms of industrial policy. You have to consider the labor supply dynamics. Are you seeing more labor supply? Is immigration a factor? How are these forces influencing how labor market dynamics are evolving? Because that then helps you gauge how inflationary dynamics are going to evolve and how the economy is going to progress.
What are some of your go-to models? I know that sounds like a simple question, but what do you use every day to think about the economy?
Well, in general, I like to essentially think about the economy with empirical frameworks, right? Models that are essentially based on prior history, relationship between variables over a long period of time, but also consider these novelties, the new normal of supply side factors playing a greater influence. And so sometimes you have to depart from what the model is saying and think a little bit more broadly about the consequences of a shock. So we were talking about supply side dynamics, and I mentioned productivity, right? In this environment, we have a very unusual development, which is the fact that productivity growth has been strengthening in a pro-cyclical manner. That's highly unusual, especially if you look back at the last few decades.
Yeah.
Why is that happening? Is there a break in the relationship between different variables? Is it possible that a higher interest rate environment is actually leading businesses to be more focused on the return on investment and paradoxically leading to stronger investment in areas that drive stronger productivity growth? That's a break in a relationship.
Yeah, pro-cyclical versus counter-cyclical. And
I was going to say, can we define those?
Oh, we're going to get into that on
Whoa,
Who Wore
there
It
we
Better.
go.
I promise. I did want to get to the Fed, though, because we're talking about all these models. And I'm wondering if you think the Fed has really updated their models appropriately. If they're operating from the correct framework, how do you see Powell? He's the ringleader here. He has mostly consensus, but there's a little dissent in the ranks. What do you think about the Fed's models?
I think you framed the question really well, because I think we really have to distinguish between Powell and the rest of the Fed. Powell, I think, is ahead of the curve in shifting his perspective on how the economy is likely to evolve.
Interesting.
The rest of the policymakers, for the majority, have essentially become entirely data dependent. So the models are out the window and they're just looking at the latest data points.
Fly by the seat of your pants?
A little bit like that.
But Powell constantly says he's being data dependent.
He's being data dependent. A lot of the other policymakers are data point dependent. So
What's that difference?
The difference is that there is way too much focus, in my opinion, on each and every data report. And the reason why this is a misled approach in the current environment is because you tend to see massive revisions to data. The data is essentially slow to develop, and you oftentimes get the wrong signals just out of looking at one payroll report or a CPI report or a retail sales report.
GDP just flipped positive. We had 2 quarters of negative GDP. Some people thought that meant recession. Well, one of them's now positive. So to your point, data gets revised.
Revisions drive me nuts, and I think Jared knows that, because I say that all the time. I say, why do we have revisions? Why do we have all this data in the first place if they're just going to revise it?
Well, in part, it's because the survey response rates are much lower than they were before the pandemic. A lot of surveys have response rates that are below 50%, which means that when you get the second read and the third read a month later, 2 months later, you get much more data. And so you get a much better picture of the economy. But that means that there can be significant revisions from one picture where the economy may be slowing to another where actually the economy is still doing quite well.
Sounds like a job for AI, maybe.
Yeah.
You just have like a government AI correspondent, answers surveys all day and nothing else.
So your view of the Fed, Powell is doing a better job at kind of pushing the conversation forward, and other members are maybe not doing as good of a job because they're getting stuck in all these individual labor prints or consumer-related prints?
I think that's the case. You were mentioning prior Fed presidents, and I
Yes.
think Fed
Greenspan.
chairs. Those prior Fed chairs were more forward-looking. They were big fans of using modeling to forecast how the economy was going to evolve and shape their views of monetary policy based on those forecasts. Powell is very different.
He's a businessman, too. He comes from private equity.
He has much more of that broader view and what I've defined as agnostic optionality. I know it's a mouthful, but essentially it means that he observes the landscape and goes into every FOMC meeting with an agnostic perspective. He's open to different trajectories for monetary policy, does not have a preconceived bias, unlike some of his peers that may be more hawkish, more dovish, and are reacting to the data. So he's pivoting the Fed towards more of that agnostic approach in terms of monetary policy. He's also pivoting towards more of a forward-looking perspective and a risk management perspective. But there's always that pull towards data point dependence, which is a key issue for the Fed.
Do you think it comes down to the fact that I just mentioned he really comes from the world of business, whereas you look at some of the previous Fed chairs, especially Bernanke and Yellen, who were more academics, do you think they're just coming at this with a different lens? Because it seemed like the process by which they gathered consensus was a bit different as well, and the degree to which they followed models.
Yeah. Absolutely. I mean, the three prior Fed chairs were very
Greenspan
much
too,
anchored, yes, in the forecasting world. I think at this juncture, though, it would be important for the Fed in general, for all Fed policymakers, to adopt a little bit more of a forward-looking perspective. I think the data point dependency is hurting the Fed because it makes the Fed extremely reactionary to every development in the economy, and it leads markets to not know what the Fed's going to do for the next move.
Yeah.
And so wild swings in markets, both fixed income and equity markets, as they're trying to gauge what the Fed's next move is going to be and how the Fed is going to interpret the very data that everybody has seen.
What do you think the Fed's next move is going to be? I'm on CME Watch Tool right now. I'm seeing 94% for
Well, that
25
can change tomorrow.
basis
I've seen that too.
This thing drives me nuts sometimes, but clearly majority think 25. What's your view?
Well, I think it's very interesting what you just mentioned in terms of pricing, because before the payroll report, there were expectations that there would be another big rate cut, a 50 basis point rate cut. That is, in my opinion, unlikely to be the case because the Fed very much remains reactionary. That's number one. The second element that I'm paying very close attention to is Fed Chair Powell has pivoted a little bit more towards a forward-looking perspective. He's mentioned, and John Williams, the New York Fed president, has also mentioned 2 rate cuts before the end of the year, 225 basis point rate cuts before the end of the year if their forecast materializes. So if the economy stays in that status quo zone of gradually decelerating inflation and the economy remaining on a relatively solid trajectory, then we would see 225 basis point rate cuts. So gradualism is likely to be the modus operandi as we navigate through the end of the year. But the big question, of course, is what happens with the elections and what happens in terms of policy for 2025.
There's a tremendous amount of nuance there. We're going to come back to it. But first, we need to take a short break. We are back, and this episode is brought to you by the number 8.04 million. And that is the number of job openings in August of this year, showing continued demand for workers. The ratio of job openings to unemployed workers, this is a key metric in the JOLTS report, it rose to 1.13. So this shows there are still slightly more jobs than people are seeking work. And also, this is on the other side. The quits rate actually dropped a bit to 1.9%, lowest since 2020, suggesting workers may be less confident about finding jobs. So kind of a mixed bag there. And the JOLTS report is a month farther behind. So we're looking at August there instead of September. But there's a lot we can kind of divine there maybe. What do you see in it?
I actually am a big fan of the JOLTS report, even though the response rates are quite low.
Back to that.
Around 35 to 40% response rates, which are very low. I like the JOLTS report because they indicate the flows in and out of the labor market. And I think the unemployment rate today is not necessarily the best indicator as to the state of the labor market.
Provocative.
Because the unemployment rate has been trending up, but historically it remains quite low, around 4%. So is the economy doing well? Is it not? I think what's happening in this new normal that we were talking about is we have a frozen labor market. We have a labor market where the hiring rate is at a decade low. That's one of the indicators in the JOLTS report. We have a hiring rate which is at a decade low, and we have a quits rate which is at a 9-year low. So what that tells you is that there is very little movement in the labor market. It's very static.
At the edges, even.
People that have a job are keeping their jobs and not necessarily looking for different opportunities. And in terms of businesses, they're being very cautious as to who they hire. But the layoffs remain historically low as well. Why? Because the value of talent has increased post-pandemic. After a period where businesses were struggling to find the right talent, to retain that talent, and to train that talent, they're very cautious as to letting go that talent at the first sign of a potential economic slowdown down the road. And so you're seeing this frozen labor market right now.
You're getting at it, but how has the pandemic just transformed the labor market, the job market overall?
Anything permanent, structural.
I think so. I think generally speaking, we have at least a structural, whether it's permanent or not is another question, but a structural shift in the labor market. The way business leaders that we speak to almost on a daily basis at EY approach their desires for talent is really this focus on, do we have the right talent? Is that talent trained? And how are we going to manage with that talent? So very cautious, very strategic about the talent needs and about how to right-size talent pools across different sectors. And doing so not so much via layoffs, but more via attrition, performance-based attrition or natural attrition.
People retire or other means. I was wondering, I want to get back to this frozen labor market. What are some of the knock-on effects of that? How does that affect other parts of the economy and fit into your overall macro view?
Well, I think the key question here, and this is the key downside risk to the economy right now, is that if we start to see more of a layoff-based approach by business leaders, that instead of just keeping their talent and ensuring they have the right talent pool in a strategic way, they proceed with more broad-based layoffs.
That's what we saw historically?
Historically, then that would essentially precipitate a faster slowdown in economic activity. Because historically, the easiest cost to shave off of a firm is labor costs. So you cut your labor force by 10%, 20%, and you reduce those labor costs by the equivalent amount. That then ensures that you're essentially as productive, more productive in terms of your capacity to serve your clients at a lower cost. But that generally led to lower income growth and in turn lower consumer spending growth. So that led to a self-fulfilling mechanism where because of lower labor market growth, you in turn saw lower consumer spending growth and lower economic activity, which fed back into lower investment.
And I want to zero in on that consumer because we've been dancing around it. We talked about the labor market. Is the consumer, I just feel like when people talk about the health of the economy, there's very mixed messaging, and same thing with the health of the consumer.
Yeah.
Is the consumer spending less? Are they spending the same amount? Are high net worth consumers spending more still? Is the consumer healthy?
I think generally speaking, or on average, yes. The consumer is relatively healthy. But I think we have to be very careful with the consumer. There is no such thing as the typical consumer in the US.
It's a big place.
It's a huge place, and there is a tremendous amount of polarization amongst consumers. I've talked about the consumer being anti-exuberant, essentially exercising prudence. But that prudence is not equal amongst all income tranches. If you break down who's spending and how much they're spending, you'll notice that the bottom 3 income quintiles, so the bottom 60% of income earners, which is a very large set of individuals, are being much more cautious with their outlays. They're selective in terms of what they buy, they're selective in terms of how much they buy, and they're very attentive to prices. They're very price sensitive. So they need incentives to draw them in to buy more. The top 2 income quintiles, and perhaps even more so the top 10% of income earners, are still spending relatively freely, and increasingly they're carrying much of the consumer spending
so the rich people are
on their back.
All right. Well, I do want to get to who are better, and we're going to switch over from the consumer to the workers side here. And this gets a little bit heady, but stick with me for just a minute. We're going to tackle here productivity on one side. So we always compare 2 things. Productivity on one side, that is workers being able to do more with less or the same. And on the other, we have structural inflation as it manifests itself through consumer prices, producer prices, labor, wage levels. And so where I'm coming from is we had this soft landing in the mid to late 1990s, 95 to 98. That was Alan's Greenspans, and arguably the only soft landing we've had since the 1950s in the US. We talked about Alan Greenspan briefly, but his whole thing was workers are becoming more productive. And because of that, it was able to counter some of the pernicious effects of price inflation. So they thought, acted accordingly, and it seemed to work out. So I guess the big question is, can it happen again? Where do you see productivity measuring out with inflation, structural inflation for the rest of the decade?
Yeah, I think you make a couple of good and important points here. In terms of inflation dynamics, I do think there is a structural upside to inflation. We talk about the 5 Ds. Demographics, aging populations requiring greater spending and therefore putting upward pressure on prices. De-risking, which is this notion of deglobalization. I think deglobalization is a misnomer, but de-risking in this environment has a cost. We're talking about higher debt levels and deficit levels, greater government spending, which is also inflationary. We're also talking about an environment of digitalization, greater investment in technologies like Gen AI, which also add to inflationary pressures, and an environment of decarbonization, greening the economy, which also brings an additional cost as an inflationary. So in general, I do think that the 2% target of central banks may actually be a floor rather than a ceiling going forward. But what is very interesting and perhaps the most important developments in the U.S. economy right now is stronger productivity growth. This pro-cyclical development of productivity growth is very encouraging. Why? Because it's the holy grail in economics. It brings you stronger supply, so stronger supply dynamics, as well as easing inflationary pressures. Because if you can do more with the same amount of labor, then it's not creating those wage pressures that you typically can be concerned about. And that is really what we should be trying to achieve. It's already happening, and I'm very encouraged by what I'm seeing because it's not all about technology at this point. It's all about business leaders focusing on efficient processes and getting the most out of their employees that are now better trained, longer tenured, and better able to generate output.
Okay, wait, but that's good for the business, the workers doing more with less sometimes?
Well,
that doesn't sound great for me.
No, because you can have stronger wage growth in a higher productivity growth environment.
Okay, so pay me more.
Wage growth right now is at a 4% pace, which is good, right? Wage growth is all that we all want. If it's offset by stronger productivity growth, it means that your employer is not necessarily paying the full cost because they're benefiting from stronger productivity that offset part of that increase in wages.
I wanted to go back to one thing you said. You said AI contributes to inflationary pressures. How does that work?
Yeah,
at first.
At first.
At first. Because we tend to jump the gun in terms of this more rapid investment in Gen AI. When you're thinking about technological revolutions, the first step is always that you need investment in that new technology. Whether it was the Industrial Revolution or electricity or computers, you need to invest the capital. Now, that increased investment at first, whether it's corporate adoption or training individuals, has a cost. And that cost needs to be factored in and tends to be inflationary at first. But the second effect is the positive effect across the economy. Stronger productivity growth, which is disinflationary, and stronger supply-side dynamics.
And to your point, we might have jumped the gun a little bit expecting Copilot to be this miracle product. I'm not picking on Microsoft in particular, but it's going to take a while for all this to filter down into the economy. Greg, we got to leave it here, but this has been eye-opening. Really appreciate you stopping by. Sid, thank you as always. And so for everybody out there, make sure you check out other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. And we're also on all your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, Amazon, and more. That's all for now. Keep your dial tuned to Yahoo Finance.